Yo, what is up, Entrepreneur DNA family? I am back with an incredible guest. If you are a business owner, or maybe you're an aspiring business owners and you aren't totally aware of all the tax write-offs and the advantages that you can have as a business owner, whether it be an LLC, S corporation, or otherwise, and you could use some help understanding how to keep more of that hard-earned money you have, this guest, Neil Jesani, is going to talk about all the things that we can do. What's up, brother?
Thank you for having me, Justin.
Yeah.
It's always great to be here.
It's great. You and I are both newer to Miami, right? You moved 6 years ago, I think you said?
6 years back from New Jersey.
Yeah, I moved during COVID. So I was in Scottsdale, Arizona, and I moved during COVID in 2021. So I've been here 4 years. You've been here 6. It's a great place. Great tax advantages.
Oh, absolutely.
No income tax.
Absolutely. Love
That's great.
I think that was one of the reason, on top of some other reason, but that was also one of the very attraction to move to Miami.
Yeah, so you run a financial firm, an accounting firm, and so this is your wheelhouse. We are going to talk taxes, we are going to talk financials, we're going to talk accounting. Talk to me a little bit about your decision. I know one of the reasons we just said, no income tax. That's big, right? So California, I was born and raised in California. I don't know if they have the worst. You might be able to tell me, but they have a terrible income tax law, right? Florida is great. You know, we as entrepreneurs, we have no income tax if we build our LLC and S-Corp and pay ourselves. Talk a little bit about your decision to move here and some of the tax advantages here for Floridians.
So I think number one reason was the tax, because once you reach at the certain stage in a life and where God has been kind and you are making lots of money, then that you want to do whatever you can. So that actually one of the reason was the saving money in tax, and it is actually substantial. So that was number one. Number two, I'm 55 now, and at the time
Thank you, man.
I was just under 50. I used to work in New York City, reached to office every day 7:30 in the morning, never left before 7:30. But now I go to New York City, my hands hurts, my ear gets cold, and so on and so forth. So I thought, I'm at this stage. It was great. Northeast is wonderful when you're young and when you're a hustler. But once you pay your price, I thought it might be time to move to Florida. And when I came in over here, I wanted to do actually summer winter. So I said, I'm gonna, put 183 days. I will become, Floridian. And so I don't need to pay to, Governor Murphy in New Jersey.
Yeah.
But I came in over here and, COVID strike, and I was stuck over here. I thought the summer would be hot, but it was okay. And
this summer was pretty hot. This one got me.
No, it is. But that I learned that the summer is a great time to go on the ocean. Yeah. That you can jump in the water. It is a wonderful, actual temperature of the water. So I loved it, and I never went back to New Jersey.
So that's a big one. Now, it's funny because me and my wife were just talking about this, right? So before we moved here, we were in Scottsdale, Arizona. She's from Florida. And so I was like, oh, great, no income tax. So I'll save 15% or so. Awesome. But then I get my property tax bill, and I'm like, this is triple what I'd be paying in Arizona. And health insurance is more. And I'm like, they're always going to get you. Like there's never like this amazing thing that I somehow win, right? Like
that ours one, New Jersey, there's also that actual property tax is very high in New Jersey. Yeah. So that for me, that was not big. Even. The only big thing I found is over here you have to renew your that actually insurance is
insurance. I spend almost $10,000 a year in fire, flood, wind, and property insurance.
No, absolutely. Yes.
It's insane.
Yeah. So it is. In fact, car insurance, actually South Florida driving, it's crazy. I have no idea. These people never give any signal, left, right. I think there's nobody trained them, that move or that give the signals. But anyway, so that was the another thing I found is it is small, but in, New Jersey, you can actually renew your car registration for 4 years or something like that one, only $20. Here, there are some 120 or for $200, and that every year you have to renew. So obviously they are trying to make some money somewhere.
Yeah.
But still, honestly, Justin, lifestyle is wonderful. I would pay anything to stay here.
Yeah, that's
absolutely.
Great. So I'm in real estate, and I want to get into some of this tax stuff because I love real estate. I will always be in real estate. A lot of people look at real estate as a great tax shelter, a great tax advantage. Do we agree? Just the
It
basic
is.
premise? It
Yes.
is. I agree as well.
Mm-hmm.
This is why I'll always buy apartments and storage facilities, any type of commercial that I can have the most tax write-off. However, I want to start this out a little more controversial. I want people to understand, like, it's not as big and beautiful as a lot of people think, right? I've gone round and round in different investments, and I own a big property in Houston. I own smaller properties in Alabama, and I'm diversified. Sometimes I have a really large tax write-off, and other times I don't, right? Where I can't get the cost segregation study to get enough value out of it to give me the bigger tax write-off. What are some misconceptions about tax write-offs, tax sheltering within the real estate that people maybe make big assumptions because they see some of the I don't know, clickbait type of social media about it? Oh, buy real estate, you get tax write-offs. But what are some missed assumptions that they're making that you can advise us on?
So I think the biggest one, and this is really big and nobody talks about, it's called active and passive. This is big, okay? So that most people don't understand. I have seen many clip online that said, hey, if you're making $200,000, you are actually W-2 employee, you can buy $200,000 worth of real estate and, that pays zero in taxes.
Right.
Not true.
Not true at all.
Not true.
Right.
So I think that's where the biggest misconception, and that it is unfortunately, it's not actually people's fault. There is so many misinformation out there. So that actually, let's go one by one in detail. So what happens is real estate, IRS puts in two categories, commercial and real estate.
Residential.
So IRS says your residential real estate will be worthless in a 27.5. So you can depreciate over the 27.5.
Yep.
And your commercial would be 38 years. Okay, fine. So now that actually technically, let's say you buy $1 million worth of condo, right? So that essentially you can write it off in 27.5. Now, you and I both know that I have owned many real estate as well, that your carpet does not last for 27.5. Your faucet, your so many things doesn't last for 27.5. So essentially, IRS allows you to do something called cost segregation study, which is actually an engineering study, and that allows you to accelerate the depreciation, basically. So generally, cost segregation study, when you do that one, is the land value obviously do not depreciate. So let's say there's a $1 million worth of condo, say $2 million, 200,000 is a land, so you're left with 800,000. And generally, you will get anywhere between 25% of that value that you can depreciate now. So the 25% of the 800,000, which is another 200,000. So meaning you would be able to depreciate $200,000 now, and with the bonus depreciation back in the new bill, obviously you can take the $200,000 as the depreciation. Now let's go in detail about active and passive. So generally, this is the depreciation. It's a passive depreciation, meaning it will offset your passive income.
Mm-hmm.
Now your W-2, K-1s, all of that one, those are active income. So you cannot offset your active income unless you convert your passive loss into active loss. And
or if you're a real estate professional, correct?
Right, exactly.
So me, I get to take that whole $200,000 immediate tax write-off year one.
Absolutely. So that is where I was going. Either you are in a business of real estate, then that obviously you are in the business, or there's only two other ways you can convert your passive depreciation in active. One is REP, real estate professional status, right? And the second one is you buy short-term, Airbnb, loophole, as we say. There's only two ways.
Now it's more of a business, right? And so now you're in the business.
Exactly.
So
exactly. So how do you become REP or the real estate professional? So these are two main rules you have to look for. One is you need to give 750 hours a year managing your property or doing something with real estate.
Yeah.
And the second one, which is very important, that 750 hours needs to be higher than any other activities you can do. So let's say if you're an engineer working for larger corporation, generally people work for 2,000 hours.
Yeah.
So obviously it's not going to work for you.
Yeah.
But if you're married and if you have your spouse, and if your spouse is not working, obviously you can make them the real estate professional.
That's right.
Or you buy the short-term rental, which is less than 7 days, Airbnb type. And that's where you need to provide 100 hours. So anybody can do the 100 hours. But there's a second condition, is as long as nobody else puts more than 100 hours, your 100 hours is higher than anybody else, then you're okay.
Yeah.
So that Airbnb type, it is easily doable. But that the real estate professional, if you're working full time, you cannot do that one. Second myth, which is also very, very important. Certain time people say, hey, I'm making $2 million. I will buy, maybe $10 million worth of real estate, and I will get the $2 million, depreciation, and I can wipe out my income zero. Not true again. There's a 461L limit. It's called the business loss limit. So if you're getting your income from a W-2 sources, basically, then IRS allows you to offset only $626,000 in a year 2025 if you're married. If you're single, then only half, basically.
As a real estate investor and entrepreneur, I've hired a lot of people. VAs, acquisition reps, lead managers, and I'll be real. Hiring can be a headache. You can get buried in resumes, but barely anyone actually fits the role. It's like trying to find a needle in a haystack, but not with ZipRecruiter. ZipRecruiter makes the hiring process way easier. They find great candidates for you fast. And right now, you can try it free at ziprecruiter.com/work. Here's the deal. The second you post a job, ZipRecruiter's smart tech kicks in and starts matching you with the quality talent immediately. Real people, real skills, no fluff. And when someone stands out, you can hit them up directly using ZipRecruiter's built-in invite to apply feature. Saves you time and gets you in front of the right people fast. So stop spinning your wheels on hiring. Let ZipRecruiter help you find the needle in the haystack. 4 out of 5 employers who post on ZipRecruiter get a quality candidate in the first day. So try it for free. ZipRecruiter.com/work. ZipRecruiter.com/work. It's the smartest way to hire. But you can still push that tax deduction forward, right?
Next year.
You still have $1.6 million or whatever, $1.4 million to be able to push next year and next year.
Absolutely.
Now, what if you are an entrepreneur? Same idea. Entrepreneur makes $2 million, but not real estate entrepreneur. Entrepreneur, a day trader.
That's fine.
Makes $2 million, buys $10 million worth of real estate. Are they able to
offset entire $2 million?
Entire.
Yes, right.
Okay.
Because when your income comes from a W-2, then 461L limit comes in.
Got it.
But so that actually we do have a client. We do have a client who makes $10 million, $20 million, and we find a depreciation which is $10 million, $20 million, and we can literally make their income zero.
Yeah.
Obviously, you don't want to go less than 20%, because that whenever you're selling it, you are going to recapture it.
That's right.
So that actually you want to be careful because it's going to be actually long-term capital gain. So that you don't want to be zero now, and when you're selling, you're paying the extra 20%. So you don't want to go less than 20%. But yes, the entrepreneur, you can do that.
Well, that's a little bit of the trap of real estate, right? To your whole point. So let's just say you take all $2 million today, like great, no taxes, but then you sell year 5. Well, you may owe taxes. You may owe $1 million in taxes now because you took $2 million, but you only got and now you're selling. So now you're like, okay, now I got to roll this over.
Correct.
So now you got to go buy more real estate. It's like the golden handcuffs of real estate. It's
exactly.
Now, also, if you don't sell it, then it's not a big deal. Who cares?
Correct.
But
unless you become wealthy.
What do you mean?
Okay. So this is very interesting. So whenever you hear people talk about real estate, primarily we talk about income tax.
Okay.
And if you're not wealthy, only thing you need to worry about is income tax.
Sure.
But once you get wealthy, now you need to worry about estate tax, death tax when you die.
That's right.
So that you would have heard people saying that, hey, you can hold the real estate until you die, right? You keep rolling it, right? And you can hold it until you die. And when you die, you get something called stepped up in a basis, right? So meaning you will get the fair market value. So let's say you bought the real estate for $2 million. When you die, the value is $30 million. Guess what? You don't need to worry about that one. When you die, you will get something called stepped up in a basis. By the way, both the party, Democrat and Republican, both were against the stepped up in a basis, but still it is there. Okay,
Yeah.
so hopefully it's going to stay there. But that actually both the parties against. But anyway, so that actually when you die, you get the stepped up in a basis. So meaning the fair market value of that your beneficiary are getting, it is $30 million. They can sell it next day for $30 million, and they have to pay zero income tax. Sounds wonderful, but now guess what? That for you to get the benefit of the stepped up in basis, you need to own the real estate. So either you own, your spouse own, or your revocable living trust, not irrevocable trust, your revocable. So meaning when the real estate is owned by yourself or your revocable living trust, it will include in your estate. So when you die, your estate will become subject to the state tax. And if it is $30 million, it will be added to your
So
estate.
if I own it with an LLC, it won't count.
No, LLC, if you own the LLC, it will count yours.
Okay, I will.
Yes.
So the same, either a revocable trust or if I own an LLC.
Correct.
Single
Single member,
same,
right, yes.
single member.
Single
Now, what
member
LLC is owned by my S corporation. I own my S corporation.
Doesn't matter. It is still owned. So only way you can circumvent this one. So that's why once you getting big in real estate, what people start doing is they will start transferring or gifting it into irrevocable trust. When you do it in an irrevocable trust, now it is out of your estate, basically. So
but then the irrevocable trust doesn't get the step-up basis.
Bingo. Yes. So that when you push it to the irrevocable trust, you will not get the stepped up in a basis.
So why would someone do that?
Right. Because the income tax rate is lower than the state tax. The state tax is 40% versus income tax is the 37%, and the long term is half of that one. So that's what it is. So that and your growth, right? Because let's say if you push your real estate, you bought for $2 million. Value is now $10 million. Now you gift it to your irrevocable trust, basically, right?
Yeah.
And at your death, it's become $30 million, right?
Right.
So that earlier that you are going to pay that actually state tax on the $30 million minus whatever exemption you get, which is somewhere around $14-15 million basically. Versus over here, you pushed it at the $10 million valuation. Now it is part of your irrevocable trust, and still the value is still $30 million basically. But that you're not paying any taxes.
You're not paying as much taxes.
Right. Yeah.
Well, so for clarity purposes, let's just say I was getting up in years. And initially I have it in my irrevocable trust because I would pay less taxes in irrevocable. And then I said, all right, I'm 69 years old. I'm now going to take it from my irrevocable trust over my revocable trust because I may any day now kick the bucket. Would that be a smart move because now it gets a step up in basis that doesn't have to be taxed by my kids?
It could be. And that the smarter way to do that one is how you take it out from your irrevocable trust is you can take as a loan from your irrevocable trust. So you do take a loan, but at the time you are technically buying the real estate at the fair market value. So no, it would not be smart move. It would not work because, at the time fair market value of that real estate is probably $29 million.
Yes,
so,
right. So
that doesn't either.
Now, to your whole point, you can go just get a bank loan, tax-free, throw it in the bank. They can sell it when they sell it, and now they sell it for $30 million, but I got a $20 million loan, so they're only getting taxed on
Bingo.
$10 million.
Right. Yeah. If you do something like that one, that is fine.
God, I love real estate. This fires me up.
Right.
There's so many ways to do it, and only an hour worth of telling it all, and there's so much more. So, by the way, make sure you are reaching out to Neil immediately. He's all over my Instagram, or this episode's going to be out soon. Make sure you reach out to Neil to understand this stuff. Let's get into something a little bit interesting because of what has happened with Trump. The big, beautiful bill passed. That is great. But you brought up something that I want to know more about as a financial advisor and an accounting firm. The right side and the left side in politics. How are they viewing the economics today? How are they viewing financials today? You just told me both sides do not like the step-up basis, right? Let's talk a little bit more about what they like and don't like, because I look at myself as a Republican. I'm socially more of a Democrat in terms of what I believe in, how I feel and how I treat people and just that whole side of it. Fiscally, I'm more of a Republican and I'm not cheap. I like nice things and whatever, but I just look at money in a way more fiscally as a Republican. Talk about the differences right now as you see them given the seat that you sit in.
And with all disclosure, my belief or my thinking is very similar. Somebody said to me earlier on when I came into this country, he said, you are, fiscally conservative, but socially liberal. So I guess, it is the same kind of category.
Yeah.
I personally like it, what is happening currently. Only thing I don't like is the debt, current debt of the U.S., that is, and that other, even most people talk about, that actually $35 trillion and so on and so forth. But actually, it is much more than that one.
Of course it is.
Because if that U.S. government were to be a public limited company, then according to the GAAP accounting standard, you also need to include all of your unfunded liabilities. So if you factor in the unfunded liability of the Social Security and, actually Medicare and so on and so forth, now you're talking about maybe $150 trillion. And that other, if you look at 50% American do not pay any taxes, okay? 50% American do not pay any taxes, only 50%.
50%.
50%.
Is that because they don't make enough to pay?
They don't make enough money. So
like
yeah, they don't make enough.
They don't make enough money. So they make like $38,000 a year less or whatever it is.
Correct. And that actually that is what the another things we can talk, that we need to somehow bring this segment of the population up, right?
Absolutely.
Basically. So
you need to lift the bottom, right?
We need to.
There's the 1%ers, right? And we've worked our face off to get to where we're at and all that. And I have my own opinions on people's work ethic, but simple things like teachers, police officers, fire, like the services, the people that are actually helping our community, it's crazy to me at times. Like, I don't know the teacher national average of salaries across the nation. I have no idea. I can tell you what is drastically too small.
Absolutely.
I would guess 4x.
And
I would 4x all their income.
And that I personally, because I have seen the other part of the world, so many people, and that other, if I may digress for a second, most American, and my kids are actually born over here. Most American, when I say they don't appreciate this country, this is a wonderful country. I'm telling you, I have probably seen 1/3 of the globe. I travel and I take my children. And Americans are hardest working people, majority.
Americans are the hardest.
Right. Americans.
No shit.
Right.
I would have thought that.
Compared to Europe, even Asia, that other Americans are hardest working. In fact, there is actually a study has been done. Most Americans do not take all of their PTO, paid time off. That is actually employer provides. Americans do not take. Okay. Now that other, I think the area of improvement is somehow nobody has said to this segment to save money. I think that is where I see.
Right. They're blowing it.
Right.
They those debt and they blow through it and they're paycheck to paycheck.
Absolutely.
They make $300,000 a year, but they're like, every month they're like, oh my God.
Absolutely. I think the lifestyle is the biggest drag. And that other, obviously inflation we've seen, rent, real estate, that actually went quite a bit up. So I think that's where you will see, but somehow you can still save some money. You don't need to save. There's actually a great story, if I may tell you over here. So that actually when I started my first company, that other one Friday I leave office somewhere around 5:00 and I'm getting call, from that other, actually some business. Long story short, one of my employee, we used to do the payroll on Friday, and that at the time we used to, give a check. Actually, it's a physical check,
back
right?
in the day,
right? Back in the day. So that woman went for the, actually check cashing service, and that person called me to actually verify that she's your employees and she's working and so on and so forth. So, I did confirm, and then I talked to this person on a Monday, and I said, you know what, I'm in a really good mood. I'm planning to give you some raise today. And she said, oh, Neil, that would be great. So I said, you know what, I'm going to start making payroll on Thursday rather than on Friday. So that from that point onward, we start doing payroll on Thursday before lunchtime. So this employee can go out on Thursday at the lunchtime. They can deposit their check in a bank, and they can save whatever 5-6% they were paying to the check, check cashing company.
Yeah.
So, and then I say to her that you can't wait for a day. Yeah. Something is wrong over here, right? That actually whatever $800, $900 check you got, you can't wait for a day and you pay somebody to get that money right away.
Right.
It means that we haven't. So I said that let's, actually from this point onward, start saving. It might be $30, it might be $40, it might be $50, but let's start putting that one in the side.
Yeah.
And that after 6 months, a year, you will start seeing maybe $5,000 in your checking account. That's and you're going to feel great. So that actually coming back over here, somehow the only thing, the big beautiful bill worries me is the debt situation. It is that somehow that it is going to add unless that we grow the GDP, and that so far it looks like that we will be. That's where Scott Besson is saying that 333, right?
Yeah.
Basically, so as long as we grow the GDP, we grow the economy, and so far, honestly. When that actually Trump declared the tariff, I went to my analyst in my office and I said, you know what? I'm feeling way more bullish in America now. That other.
How do you feel? So you just said how you feel about tariffs, but like it's really hitting America pretty hard.
Oh,
and how long do you think it will hit? Like this is the ripping the Band-Aid off, in my opinion. I'm not political. And I'm not an economist, and I'm not a financial advisor. I just know some things, and I interview some really smart people.
Sure.
I feel like what he is doing with the tariffs is saying it is either death by a million paper cuts or sever the arm. Choose. You either die by a million paper cuts or you cut your arm off and you live forever. And he's saying, I'm going to cut the arm off. Like, we are going to make this an issue. It's going to hurt a lot, but then we will rebound. Is that...
I agree.
No,
that actually I agree with tariff. In fact, that I'll give you a quick example. This is another story I think you're going to love. So I went to India in January of this year, 2025. I went for a few days. My nephew owns the, store for, extra glasses. So I wear reading glasses. And that he said, Uncle, I can make something called, extra progressive for you. I had no idea. Anyway, I bought 3 pairs of the glasses, from him. He said it will take 2 weeks. I will ship it to, U.S. So I that came back. It was fine. I bought it for some $500-$600 or something like that one, U.S. dollar.
Yeah.
Anyway, so that actually he shipped the 3 glasses. It came in over here. All good. It is somewhere came in, March or something like that one, February, March. Anyway, I tried and I did not like it because, progressive is not that easy to get used to.
Not at all. These are progressive.
Is it?
Hard. So under here I can read, and then over here
it's hard. Right.
It starts to give you a headache a little bit.
Right. Yeah. Somehow. So, my nephew said that, Uncle, I would like to fix it. These are very expensive glasses for you. Why don't you ship it back? And I said, no, don't worry. He said, no, ship it back. So, my wife goes and, she ship it to, India. So I that asked her, how much was that one? She said, no, it was some, $50-$60 to ship to India. Fine. Now the story begins. After a few days, she said, somehow FedEx charged me some $360. I said, $360 to ship to India? So that she called FedEx. Guess what? India charged $300 tariff on the glasses, which I bought it from India.
Yeah.
Sending it back to repair it.
Yeah.
They charge $300 tariff on it.
Because it was entering the country.
Entering the company. So that if you look at that one, I mean, somehow people across the globe, they have used and abused America, So I think up to some extent that we need to level the playing field.
Yeah.
Actually, that's been said that you also need to be mindful, even with no tariff and so on and so forth. We are still number 1 country on the earth, and we become number 1. So that whatever we have done up to some extent, it is right. whatever something broken, that's what we have to fix. And I think that is where that is a tariff. Tariff might help up to some extent over there. That's been said, I guess. Knowing President Trump, he's a very smart guy. He's a businessman. I particularly believe, even though he shows that one, he has an ego, but he has no ego. He can walk back. He can be very flexible. He can be very nimble. So the appropriate opportunity come, he will make a deal with people and make it work. So I'm personally very, very upbeat. Very bullish on America at the moment.
I mean, that's great. I'm interested to see on all the different things that he's doing, right? I think between immigration and tariffs and, listen, I'm even in construction, like the cost of things is insane right now, right?
Correct.
And so something has to be done because it's not COVID anymore. The ships aren't lost at sea with all the products. Like everything's landed. We shouldn't have material costs the way we are. It doesn't make any sense. It's hurting everybody. Everyone, even people who do financially well, you're like, why does this cost this much?
I think up to some extent, I personally believe that some of the upper middle class business owners took the advantage of the COVID.
Of course.
So meaning they got the opportunity to raise the price of a menu. They got the opportunity to raise the price of their plumbing services, electric services. Everybody raised the price, even though there was no need. And then COVID is gone, but still they haven't lowered the price. So I think some people, so if you look at that one, I'm in a business of money, right? I mean, that the only time I'm talking to somebody when they have a tax problem, I mean, we deal with people who makes more than $2 million, right? I see money. There's lots of money out there. There's so many people makes lots of money. So I think that if you look at, there's always some winners and losers, right? So that one, but obviously losers don't need us. Only the winners need us, right? Basically. Yeah. So I see that I can see that there's so many, even the normal businesses, which you can't imagine, they are making tremendous amount of money. So I personally believe that these people did very, very well, but it's, actually bottom 50% is probably paying the price.
Yeah. I mean, listen, yesterday I went to go get it was Sunday. I went to go get just like a breakfast burrito. It was $21 for eggs, beans, rice, bacon. You're like, it's a breakfast burrito. It's $21. Anyways. So given where you sit, knowing the amount of people that make money, and it could be real estate, what would be your number one tax write-off suggestion? And I don't care the vertical, whether they day trade or they do hair for a living. They do really well.
Sure.
Where would you typically suggest? What's your number one suggestion for tax write-offs?
Sure.
Is it real? And maybe it is, maybe it isn't.
No, so that number one is actually depreciation-based strategy, basically. So it could be real estate.
Mm-hmm.
You could use, actually, believe it or not, and that we do quite a bit, you can use the equipment.
Oh, yeah.
And
that's huge.
Right. That one is huge. And why equipment? Because let's take the same example of the $1 million condo.
Mm-hmm.
If you buy $1 million condo, that you get $200,000 writes off, right?
Right.
With the cost segregation study. If you buy $1 million worth of equipment, you can write off 100%. Mm-hmm. So equipments are way more efficient than real estate in terms of tax side. Okay?
That's right.
I'm not talking about investment, obviously.
So like people make money in oil and you buy a new oil rig, it's 100% tax write-off.
Correct. So that are the equipment. So we do, quite a bit, equipment deal, basically. So that's where, so that it is very similar like a managed services, basically. So somebody want to buy the equipment in a big equipment and, you just create your LLC. You buy inside your LLC, they will manage it and they will pay you some, that actual return on investment and you will get entire, tax write-off. So that would be one strategy.
What would be a good piece of equipment? Because now people are probably thinking, I got to go buy equipment. What would you suggest?
So that there's somehow we like actually heavy construction equipment. Those are very, very good. That's one truly holds the value.
Yeah.
Those kind of things. So I think that is one we like it quite a bit. And what we do even in that one is that actually some of the companies we deal with, they use the same IRS code of Airbnb loophole, right?
Yeah.
Short-term rental, basically.
And
So rent it for less than 7 days, you can become active as long as you give 100 hours. And now you can offset your...
So I could go in and buy a bulldozer.
Bingo.
And start short-term renting it out to construction companies. I get 100% tax write-off for whatever they cost and whatever income that I'm producing. And maybe I don't even want to produce income, but I just don't want to have to sell it. Because if I do sell it just like real estate, then I have to go
recapture
the tax write-off I got.
Correct. And that the good thing is about equipment is after 5-6 years, value of equipment is 50%. So even though you recapture, you are recapturing only 50% value.
After 5 years.
After 5-6 years, yeah. So that's actually, so that one is actually wonderful. That's been said, real estate has always its value because that other, I think, that people talk much more about taxes about the real estate, but I think real estate has much more value in terms of investment as well. So I personally believe, and that I have invested quite, maybe for last 15, 16 years in the real estate. And my primary logic is it makes sense from investment perspective.
That's right.
Tax is the additional benefit. Yes, I do factor in, but it's the investment. Does it make sense from the investment perspective? And that once it makes investment perspective, then you factor in the tax. So I think real estate has a much more other value that we are missing sometime. And that when you only buy from tax perspective, that's where actually disappointment comes. But if you buy for right reason, then you're going to stay in a game and you can really take a benefit. Because I personally believe in that real estate way more than I am. But real estate is funny. The real estate is not like a stock market, right? Apple stock, you can be in America, you can be in Africa, you can be in Asia. It is still the same price.
That's right.
Real estate, even you go 10 miles and it's a whole together different ball game.
Yep.
Right. So real estate is, that's actually very, very different than any other investment. So I personally believe there's always opportunity in real estate. You need to just find it. You need to work hard. And sometimes people are lazy. They don't want to put in the efforts. You need to,
I agree.
You need to, really, really work hard.
It's, this is one of my favorite subjects to the point I created this podcast because I want people to understand financial literacy. I want them to understand the things that Again, make sure you are reaching out to Neil. Before we end here, I want to know a little bit more about what you would advise someone starting, the new entrepreneur. I'm going for it, Neil. I'm ready. I'm hungry. If you could grab that person, sit them down for a cup of coffee and really give them the lessons financially, here's what to do. Here's how you start. This is how you should be thinking. What would you suggest to that person?
So I would say 3, main areas. So one is, I'm not sure, Chet Holmes, but Chet Holmes passed away now, but he used to say, anybody can make a good living by working half day, and half day meaning 12 hours. Okay. Yeah. So meaning number one is you need to work.
Put in the work.
You need to put the hours. So that's number one. Number 2 is being best at what you do. You want to know more than anybody else. I don't care if I know more than you about some sports or some other stuff, but whatever I do for a living, I need to know more than anybody else.
Yeah.
So being best at what you do, I guess, right? Third thing is also very, very important is your ethics. You don't want to compromise your ethics because end of the day, that actually when you don't have a lot more money, you think so money is the goal, but goal is not money. Goal is to be happy.
Yeah.
And the happiness comes when you do it right way, right? Basically. So these are the 3 things, that I personally believe diligence always pay. So you can be average person, and if you're putting the efforts, you will, outsmart the other smart people if they're lazy, right? So so coming back, the hard work, being best at that actually what you do, and, being ethical.
Yeah.
That's been said. On the financial side, I would probably say, create the single member LLC initially. You don't need to go crazy, do that one. Once you start seeing the traction, once you see the revenue, once you're 100,000 plus, then you can probably elect as the S-Corp or so. If you're buying the other real estate for other reason, you can do that other many single single member LLCs, and obviously your show has talked quite a bit, and I'm sure your viewers knows about that one. So I'm not going to go about jurisdiction and so on and so forth, basically. But yes, those are things. But I would probably say don't worry about the that money and taxes. First, worry about creating a problem of tax, meaning creating a problem of real revenue. That's very hard. That one. You understand that actually becoming successful in business, it's not easy.
No, it's not. It takes a lot of work.
It is very.
And a lot of times you become an overnight success because you did all this work when no one saw you, and all of a sudden you became successful enough that you had got notoriety, and they're like, man, what an overnight success. And you're like, I've been eating shit for a decade.
Bingo.
And it's not that easy. The last one, I think this is a fun topic because everyone talks about it, but talk to us about the tax write-off of the cars. 100, what is the 176 or 179?
Right, yeah. So
like I just bought a new Range Rover. Okay. Exactly. So it's over 6,000 pounds. But exactly how does that write off? Because some people have the misconception again. Let's just say my payment is $2,000. Do I get to write off all $2,000 every single month? Or is it just the interest of the principal?
So are you buying or you are leasing?
I bought.
Right. So if you're buying, ideally, what you should do so that if it is for 100% business purpose, right? Basically,
yeah.
So you can take the actual 100% write-off, basically.
$2,000.
No, that the entire value, so that you bought it.
Yeah.
So it doesn't matter how you're paying. You're paying cash or you're financing. Let's say value of a car is $150,000.
Yeah.
You're taking write-off for the $150,000.
Yeah.
Simple as that, because it is for a business, basically. So that's what it is. Now that other people don't realize that if you're not utilizing for business, then there's an issue, basically, right? So that's where.
And this is the gray area we talked about before.
This is where the gray.
How do you prove it? How many miles? Where did you go? Like now, this is I go round and round with my accountant. It only matters if you get audited.
Correct.
Right.
If you get caught,
if you're going to be pushing the lines, like we were talking about off camera. This thing over here might actually catch you. It may not be the car thing, but this thing that you did over here, you didn't even think about.
Correct.
Causes the red flag. The IRS says, hold on, so-and-so did this thing over here. Meanwhile, you're trying to push the lines over here. They don't catch it. But now they're going to go look at everything.
Exactly. In fact, if you look at that one, that the audit, statistics, one of the high audit area is people who makes less than $140,000 and takes, deduction on their Schedule C. Which is car, business travel, business meal,
and
home office.
$100,000 on Schedule C.
Yeah, so you need to be very, very careful. So that actually, this is what I would say. Devil is in the detail.
Yeah.
Give the record, and that's where it gets harder. So when you are small, you can keep the records, but once you are making lots of money, you don't have a time to get the receipt. For the $200 dinner you had with your actual prospect, basically, right? You don't, basically. So that's where it gets harder. But when you're that actually starting out, I would keep the receipt of everything. I would probably take a quick picture. Write it down.
There's apps like Expensify.
Yeah,
right.
Something
like
that
make it a little bit easier, right?
Something like that one. As long as you have the detail, that's going to help you, basically. But that is what I would say. And that actually we did talk, off camera. There are so many legal strategies available. So, you probably don't need to push to the gray area, gray area, because if you can get it, everything legally and ethically, why need to go there? Basically, you can do, depreciation-based strategy. You can do some, charitable-based strategy that are also actually profound, once you have some money, basically.
So as you're in my community of all the guests, and most of my guests are high income earners, what would be, and this is where we'll leave it, last question, what would be your biggest tip for the higher income earners making, let's just say, north of 500,000, most likely making it? What's the first thing you'd say, guys, you need to be looking at this if you aren't?
So I would look at depreciation is the first.
Okay.
Now that, as I mentioned, once you cross 626,000. So meaning if you're making $2 million, depreciation can only give you 626,000 if you are pure W-2 earners, basically. Right. If you're a business owner, you can get as much as you want, right? So then you stack on top of that one is some charitable strategy. Charitable strategy is very, very powerful. And that other, you feel good as well because, that other, you have been fortunate. God has given you something. So by doing good, you are able to take some, hefty deduction for yourself. So
charitable deduction. So you write a check to whatever charity. What's the write-off for charities?
That actually you can do so many other ways, so many creative ways. So that actually charitable donation can be, say, for example, in the form of writing a check to charity directly, right?
Yeah.
Number 2 could be donor advice fund. Number 3, you can create a trust, CRETs and CRUTs, or you can create your own foundation, right?
Yeah.
And the other one is you can also become part of some LLCs and you can get multiples of your money. You buy at the early stage, you buy at the lower price. When you're actually donating, you're getting multiple of that one.
Yeah.
It is very, very attractive. So there's so many wonderful strategies.
I'm glad we ended with because this is a perfect reason for me to say, go get a hold of this man right now. There's just so many great strategies that because I come from real estate, it becomes always top of mind. But for people who are out there making money, and even if you're about to make money, understand what you have in front of you. And so, Neil, I really appreciate it. Make sure you follow Neil Jesani everywhere. What website can they go to if you want to push them to a website?
They can go to neiljesani.com, NeilJesani.com.
I appreciate you, brother. If this was helpful to you guys out there and you're like, wow, I didn't know that, make sure you like this and make sure you share this episode with at least 2 of your friends. We'll see you on the next episode.
You are the best, Justin.
Thank you.